Hello, my name is Tony. Please excuse my voice since I'm feeling a little under the weather. So I will try to speak clearly so that you can understand what I'm saying. But I am putting together a presentation about what's going on in the stock market so that I can inform everyone about the potential risk that we're about to face. So let me just go ahead and start with a little background on myself. I have been trading stocks since 2002 at the age of 19 when I took a $2,000 investment and made a conservative return after my broker recommended that I not invest in American Airlines. I wanted to invest in American Airlines right after 9/11, the summer of 2002. It was currently trading at 125. But out of the fear of the company going bankrupt, my broker talked me out of it. So, like I said, I made a more conservative approach, made a $500 return. Well, 2 years later, American Airlines was trading at $22 a share. So I could have taken that $2,000 investment and made a $44,000 return. That was pretty much my first lesson in stocks. So as I continued to trade, as I continued to learn about the stock market, I realized that there was something more to trading stocks than just buying what you like and holding and trying to make a return. So, and then in 2008, I met a guy who ended up being my mentor and teaching me how the stock market works. And it actually happened by chance. I was going to Texas State at the time, and I ended up going to the track to kind of just think about my day and read a book. And there was this guy who was talking to his friend about the stock market. And keep this in mind. This was in 2008, right about June, July. And that was when the stock market was coming down. Like I said, that was in 2008, right around June, July, right at this area. So what was going on was the market had come down some, and every broker that I spoke to had said that the market was just going to go back up, it was going to recover, don't worry, no big thing. And then I ran into my friend, who let's just call John. John was talking and saying, well, the stock market, when it comes down, it's going to come down to about the 600 level. And me being, kind of young, I had no idea how anybody could predict this information. So he invited me to his apartment, where John showed me what I'm showing you right now. And I had no clue what to make of this information, this data. And he said, look, if you look to the left and you see this low trading around 800, that's what the stock market was going to drop to. So I was like, okay, that's interesting. I've never seen anybody come up with this information. And so that's where it all began for me. He showed me this piece of knowledge, and I was captivated by it. I wanted to learn what he learned, or what he knew. And so as I was going to school, I started kind of trading in commodities, gold, corn, since I was farming at the time. And then I got into derivatives or index futures. The S&P, the S&P, the Nasdaq, the Dow, they're all derivatives when you trade the futures. So that's where the big money is. That's where this is where the game starts. When you're trading, it's a game. When you're investing, I know some of y'all might not like this, but when you're investing, it's a game. You get in low, sell high to make a profit. A lot of people will say, well, you gotta stay in there long term. That's a great philosophy. That's a great idea if you get into the right stocks. And I'll show you. I'll show you at the very, well, you know what? Let me just go ahead and show you now. Let's say you put in $10,000 in March 2000. You put in $10,000. The market took a decline. So you probably lost about half. So now in 2002, you only had $5,000. Well, then the market makes another run back up. But guess what? October 2007, you're back at the $10,000. And then the market takes another decline in 2009. You just took another hit. You lost $5,000. But then you decide, well, let me just stay in. I started off with 10. I'm back to 5. Now in 2013, you made your 5,000 back, so now you're up to 10,000. But now we're looking at 2015. So you're probably at under 15,000. So in 20 years, if you were trading, the ETS, or any of the sort that goes along with the S&P, you in 15 years, you actually only made $4,000. What my mentor John taught me is you can get out up here, buy back in down here, get back out up here, and then get back in down here. So let's say you said, well, I'm at a top on the market. It's going to come down, so let me just hold off my 10,000. You got in here, you made 5,000, you got out, you made, let's just for number's sake, you made 15,000. So you made 20,000. From 2002 to 2007, you made 5,000. From 2009 to current, you made 15,000. So you made 20,000 total. So your 10,000 is up to 30,000. If you would have played the trading game. All right. So let's move on. Let me share the information that a lot of people are not aware of, so that you can get an idea of what's about to happen. And you have to remember this. This information that I'm about to share with you, it's not a guess. It's not one of those games where you kind of, you sit around the coffee table, or you sit around with a group of friends and you say, well, I like such and such because this and that. This isn't how we play this game. What I'm sharing with you is my research, my experience, and my knowledge of how the stock market works. I use this information to make decisions about where I'm going to invest my money, how I'm going to invest it, and when I'm going to take profits. So the information that I'm giving you is what I use to make a return. So this isn't some information that, I decided, I woke up one morning and said, oh, let me just put this together. No, this is what makes money. And let me just remind you something else. I'm not here to make you money. I am here to educate you and to help you understand about what happened, what's going on, and what's about to happen. So this is more like the past, the present, and the future. So let's just go ahead and get started with a little more information. Okay. We're going to go to this. This is the daily on the S&P. We're actually going to break it down just a little more into the hourly, so that I could give you a better picture of what goes on and how it works. And I'm going to get rid of these lines. These lines are actually lines that I drew to help me determine the direction of the market. Okay, so you see this yellow line right here? This is called the moving average. And you have to understand this about the moving average. When the price, well, let me backtrack a little bit. I'm sorry. The method that I use to analyze the stock market in stock charts, it's called technical analysis. Technical analysis uses charts and other tools to identify patterns that can suggest future activity. So now let me go into how these indicators work. You have price. Price are these. Price is right now the S&P futures is currently trading at 21.05. That's price. Price never lies. Price doesn't discriminate. So if you're wrong, you're wrong. If you're right, you're right. But what price does is, price either stays above or below the moving average, which is that yellow line. When in the moving average state, the moving average is used to help determine trend. If the price is above the moving average, the trend is up. If the price is below the moving average, the trend is down. So, and then also I use another indicator. It's called slow stochastics. It's this down here. When price is moving up and down, stochastics will let you know whether it's overbought, which is one of these, and then oversold. If it is oversold, there's room for it to go up. And you got to remember too, just because something is overbought doesn't mean it's coming down, because you have to add all these indicators together. For instance, you take this section right here. It's clearly overbought, but the price is above the moving average, so that means it's going to continue going up. But then now take this over here on this section. Price, or the statistics is overbought, but yet it starts trending down until it gets oversold. Which also, if you take a look at this over here, it's overbought, and then it drops to an oversold position. But see this right here, price is below the moving average, so it drops, pops back up and drops, and then it stays down until price gets above that moving average and holds, and then that's when it takes off to the upside. So you can't just go on one indicator, you have to go on multiple indicators. And this is how you figure out to help you understand the direction of the move. And the reason I'm telling you this right now, because towards the end, I'm going to put this together and show you what's about to happen. Remember, we use indicators to help determine the future price of the stock market. Okay. So let's look at something a lot of people aren't watching very closely. If you think about it, a lot of people are kind of speculating on oil. I've heard a lot of people say, well, you know, oil's going to go down to 30 to 10. And then I've heard other people say, well, it's going to go back up. Nobody really knows. You know, it's got to go up. It always goes up. Well, let me just tell you right now, there's something bigger going on with oil that a lot of people aren't aware of, and I think that's where it's going to catch a lot of people by surprise. So let's take a look at that. If I can find my oil. Okay, and one other quick thing. When you're looking at the stock market, a lot of people probably look at line graphs. I look at bar graphs, but I also look at the monthly, the weekly, the daily, to try to figure out the big picture. But if I'm trying to scalp the market for a few bucks, I'm going to look at the hourly, the 10-minute, and the minute. But to help you understand what's going on in the stock market, we're going to go to the monthly, the weekly, and the daily. So this is what the oil price looks like. This is what the chart on oil looks like. This is an interesting pattern. Because in 2008 we hit a high of 147. Then when the market, I hate to break it to y'all, but this was not a crash. This was a panic. When the market panicked, it dropped to a low of $33, and then for the next 5 to 6 years, the market went up, sideways, pretty much sideways, and then it hit this point. Back in 2011, we hit a high of 114, and if you remember, between 2002 and 2014, there were actually disturbance in the oil supply. There was one in Libya where they overthrew Gaddafi, and then there was one in Syria where there was kind of a civil war going on. But did you notice anything about 2012 to 2014? Price never went above the 2011 year. It never went above that, which meant there was something bigger going on that hindered oil prices from going higher, back up to 140, 147. When you see that, as a technical analyst, as a trader, when we see things like that, from experience, that tells us that this market was going to go down. So when it broke to the downside, I personally was not surprised. My question was, how far was it going to go? And so I believe we have seen the bottom at 43. I mean, don't hold me to that, but that's my expectation. I believe that we have seen the bottom and that the next move is up. But what on this drop made this whole chart right here very interesting, because when you're trading technical analysis, you look for patterns. And right now I'm gonna tell you that this is a bullish pattern. You have point number 1, point number 2, point number 3, and point number 4. This drop in oil prices set up point number 4. If this is a bullish pattern, this line right here, in order to find your target objective, you take the bottom of point number 2 and draw a line to the blue line on where it intersects the blue line. Then you take this line and you kind of estimate where this line where price will exit this pattern, and from there let's just say right there, let's just say August, that price will exit this bullish triangle. And if you take this line and you put it right there, that is about, I want to say 80. Yes, this line is about an 80 point difference. So if it exits the bullish pattern at about 100, you're looking at a price of $180 a barrel for oil. So what does that tell you? This bullish pattern plus the target objective is saying that oil is going to go up to 180. Yeah, you're probably thinking that this isn't possible. There's no way this is going to happen. The economy's slowing down. There's really no global demand for oil. And you're probably wondering, if this were to happen, how? Well, we'll get to that in a second. But so let me just kind of help you understand it real quick again. We have a bullish pattern. The price target objective is 180 from my point number 2 to that blue line, going from point number 1 to point number 3. So when I saw this, I was trying to figure out, if it goes up, why is it going to go up And is anybody else realizing that oil prices is going to go up? Which I did some research. This is very interesting. This is why you should always keep up with current events. Let's go to this first. Okay. This is a prediction from the Secretary of OPEC, Al Badarbi. A while back, when was this? Okay, so February 9th. Actually less than a month ago, about 3 weeks ago. 3 weeks ago, OPEC Secretary General announces that the oil prices may have bottomed out. Indeed, we have had 4 straight days of increases and predicted that you will see more than $200 when it comes to future oil prices. This actually popped up about a week after I figured out that I had a bullish pattern. So I found this very interesting. So let me explain to you. Let me just read you this one section. Abadari is not stupid. He has held several high-ranking positions in Libya. Starting in 1990 as Minister of Oil, he was appointed Secretary General for OPEC in 2007. His January 26, 200 barrel prediction focuses on the future production losses that will result from industry pulling back, which, as outlined above, are not likely to result in $200 oil. So the person who wrote this article said, hey, this guy's predicting $200 oil, but that's not likely to happen because even with the demand, or even with the production pulling back, that's not possible. So the next section, it really kind of makes you wonder, what's going on? Snyder believes that Abadari may be signaling something bigger. The only way for prices to reach the level mentioned is for there to be a decline in available supplies through a disruption in production or a break in supply chain. Well, that's very possible, but what caught my attention was that it may signal something bigger than we've ever seen. So that was interesting to me. So my chart has a bullish pattern with a target price of 180, and then the Secretary of OPEC says that we're going to see $200 oil. Interesting. Now let me show you something else. Let me show you another article. George Soros. George Soros and Warren Buffett are 2 insiders that John has taught me to follow because they have so much net worth that they make good investments and they make good returns. They know what's going on. So I've learned to kind of follow George Soros. And what interests me about this article, keep in mind, and I'll put the dates out to you, February 18, 2015. Soros bets on Devon Energy Transocean ahead of oil price rise. Now, so let's move down. Okay. So the hedge fund firm, which manages the investments of George Soros and his family, bought 385,000 shares of Devon Energy and 149 shares of Transocean in the fourth quarter. You have to understand that the fourth quarter was October, November, and December. That was fourth quarter. Let's go back to the charts. Oil prices. Right. Okay, so we have, well, let's break it down a little more. Let's go back to the weekly. So October starts here. Fourth quarter is from here to here. So as oil, and keep this in mind, George Soros was buying oil at 80, 70, and $60. Why is he paying that much when he could have waited and bought it at $40? You got, like I said, let me just go back and say this again. These individuals have so much wealth that if you start buying, if they waited to buy down here, somebody would catch it and automatically know what he was doing. So instead, he slowly bought as it was coming down, and nobody was aware that he had bought a lot of shares. But what makes this article more interesting is that he bought at $80, $70, and $60. He's expecting a huge increase in price. That if you bought at 80, then and you expect to double your fund, you know your stock price, there's a reason he's buying all that. So let's go back to this article. Okay, let me go down a little further and show you something else, which I thought was pretty interesting. Soros' purchase of Transocean also came ahead of the company's announcement. Well, you know, so he bought this as some bad news was coming, so that they actually dropped a little lower. But the firm also dumped its stake in technology companies, Google, Apple, and Intel, while also liquidating positions in Walmart stores and Netflix during the quarter. So you're telling me that as the stock market was going up, let's go back to the stock market. We'll keep that on the weekly. October. This is October and this is January. So we took a hit in October. So as the stock market is going back up, George Soros, let's drop that to it daily, so you can get a bigger understanding. Here we go. So as this stock market is going back up, see, this is October, we're back in November, and now we're in December. So in this phase right here, between this low and this low, George Soros, let me say those things again. George Soros oh my goodness. George Soros was dumping Google, Apple, and Intel. And he was also liquidating his market, the Walmart stores, and Netflix. Interesting. By dumping the stake in Apple, the fund missed out on 16% rally on the iPhone maker's share this year. I mean, really think about it. Why was he dumping a lot of quality stocks who made money and getting into two stocks that was actually dropping because of oil prices? If you haven't really figured this out, let me just point it to you. Let me point it out to you. He knows the stock market's going to drop. He knows that oil prices are going to go up. So he got out of all of his stocks and jumped into something that was going to make a return. Okay. So now that you understand what's going on there, let's go to stocks. Let's look at the bigger picture. This chart right here tells you a story. A lot of people are not aware of what's going on. So let me let me try to explain it to you as well as I can. So let's go back to the beginning. March 2000, the S&P hit a high. It hit a high of 1552. 2 years later, the stock market hit a low. And I'm actually going to draw you something because I'm going to show you something interesting. This is a trend line. Wow. It's more like a falling wedge. Okay, we're going to keep that for a second there. So you hit a low on October 2002. And then you started moving back up. You hit another high in October 2007. And then we started dropping, and then we had the mortgage crisis. And you hit a low at 666 on March 9th, 2009. Does anybody see a pattern there? And I mean, I pretty much pointed it out for you. If you take that high of March 2002 and you take this high in 2007 in October, that will be 7 years. 7 years. Now, if you take the same thing, you take October 2002 and then March 2009, those years matter. There is a 7-year cycle. 2-year drop, 5-year incline. 2-year drop, and then we should have an incline here. But my point is, from this low to this low is 7 years. From this high to this high is 7 years. What does that tell us? This is where we are currently. Currently, we're trading up here at around 2104, 2105. This low to current high has been almost exactly 6 years. 6 years, huh? Interesting. If we are in a 7-year pattern, what does that mean? That means that we lack 1 more year before we hit a bottom. Yes, you heard me correctly. This is a 6-year bullish run. Now, it's gonna, within a year, we should have a low. 7 years? 7 years. Because we've already surpassed the 5 years, now we're going into the 6th year, we have 1 year to decline. So the decline should end in 2016. We had just entered 15, I'm sorry. Now, so what else makes this chart, this present chart that I'm showing you, very interesting? Did anybody notice? Let me compress it a little more. March. October. Huh, interesting. Why did we have market tops and market bottoms both on October and March? That I really don't know. I mean, I've been trying to figure that out for a while. I have no explanation. Your guess is better than mine. But I will show you something else that made it more interesting. Let's go back to the daily. So you hit a top in September. You had this massive decline and then shot back up, all in the same month of what? October. This is where it gets interesting. Now this is where you can either believe me or not believe me. That's your decision. But we had this massive drop and this massive pickup. That was 1960 to about, what was that low? 1820. So 140 point drop. So you had a 140 point drop and then a 140 point move up, all within the same month, if not a little more. Well, let's go back a little more. Let's go back to that month. If this 15-year chart is correct, the market should start dropping sometime in March. That's actually tomorrow. I'm doing this on the 28th of February, and tomorrow will be the first day of March. So starting tomorrow, you will see a topping out in the stock market. You will see the end of a bull run, and then you should start seeing a decline. Interesting. Like I said, you can believe me or not. To me, it makes no difference. Okay, so let's go to bonds real quick, because I gave a presentation on Thursday and somebody asked me about bonds, and I never even thought to look at bonds. I mean, I do look at bonds, but I didn't realize how they were going to be affected by a stock market decline. So let's go ahead and look at bonds. Okay, we're going to take a look at the 10-year note. What's so interesting about bonds is that when the stock market goes up, the bonds drop. Bonds drop. When the bonds go up, when the bonds go up, the market declines. So you see this a lot. Let's just point this one out. This is on the day, October 15th. You saw a huge spike in bonds. So from September 19th to October 15th, you saw this incline in bond prices. Interesting. Now let's go back to the stock market. From this peak of September 19th to this low, the stock market declined. So the stock market declined, bonds incline. What does that tell you? When people get scared, they run to a safe haven investment, which is a lot of people consider bonds very safe. But what people don't realize is we're pretty much at a bond bubble. When this bond bubble bursts, the stock market, the interest rates will skyrocket. But you're kind of wondering, how is that going to happen? Why would that happen? Well, let me show you something. I found this actually today when I was doing some research. Let's look at the Great Depression, the crash of 1929. You see interest rates at about 5%, and then it declines. You have interest rates at almost 2%. So from let's just say 1920 to about 1950, so about 30 years, somewhere around there, you saw a decline and the market drop. I mean, you saw a decline and so bonds went up, interest rates went down. And what I found very interesting about this, the longer you held interest rates at a low level, the higher the interest rates went up. It's kind of, have you ever twisted a rubber band, and the more you twist it, the faster it, when you let it go, the faster it unravels? This is kind of what's going on. And the reason I say that, now if you look at this, if you look at interest rates from about 1980, you see a drop. And what I found very fascinating, if you go from about 1887, you saw a slow decline of interest rates. And you're kind of wondering, why does this matter? Do you see this slow decline? If you draw an imaginary line from that high around 1987, if you draw an imaginary line on these little peaks, just a slow line, and then you draw another one. Where did you see this earlier? I showed it to you. I even drew it for you. Now let's go back to those charts. Let's go to daily. This is that same line. Well, okay. So what happened? You have price in between these two lines. When it broke out, the market went back up. See how it shot up? You see this low decline, and then price broke out of the decline and then shot up. This right here, this slow decline, is telling you interest rates were going to skyrocket. And my guess, this is just more like a 50-50 guess. My guess is going to shoot up to 14-15%. Once interest rate price breaks out of these two, in between these two lines, it's going back up to 14%. That's just a guess, but it's not a pretty guess. So why am I telling you this? Okay, let's go back to bonds. Bonds. Okay. Let's go to the other chart. Bonds. When the stock market starts dropping, bonds will go up. You have to be careful with that, because this is a bubble, or I believe this is a bubble. It's more like a kind of a, it's a, like we usually call it a bull rally trap. So when the stock market's dropping and everybody's jumping into bonds, we're going to see that, and we're going to see a bull rally trap. Now, why do I tell you that this is a top? Remember what I told you about this indicator? Slow stochastics? The stock market is overbought on the daily. Now, if you break it down to a monthly, you have been overbought for a long period of time. So that means the next move is expected to be down. This this slow stochastics should start trending down back to oversold before it can make another move up. So not only do you have the monthly overbought, you also have the daily overbought. The daily is overbought. And the weekly is overbought. So you have all three of those overbought. The next move has to be down. But you're wondering, well, how far is it going to go down? I already showed you how far it was going to go down. I already told you how far it was going to go down. We got to go to this chart. So when the market starts coming down, we are going to, you're going to drop to at least under 1,000. The target level is going to be about 800. So if you look at this chart again, you have two 7-year cycles, and you've already inclined for 6 years in a bull market. That means you have 1 year left. Your indicators are telling you it's overbought. That means it has to come down, and the target price is going to be about 800. These two lows. So let me just, I don't mean to be the bearer of bad news, but like I said, I'm just sharing information with you all. This is what I use to figure out what's about to happen, so that I can place a trade, and understand that you don't have to believe me, but I'm just sharing this information with you because I've been doing this for such a long time. So let me just go ahead and conclude everything. We're in a 7-year pattern. We've been in a 6-year bull market rally. Now we have a year left before we hit our downside objective. I personally don't recommend stepping in this, in front of a moving train that's going downhill. I am more likely, with my family's investments, I'm going to sidestep. I'm just going to get out and let this market drop, and then start looking for a good, investments down here at the bottom. I can't tell you what to do. I'm not your financial advisor. I'm not a financial advisor, and I'm not really interested in being anybody's financial advisor at this moment. My main objective is to invest my family's funds in order to make a return. So if you have any questions, if you want to know how you can make a return, talk to your financial advisor. I highly recommend it. But like I said, we are in a 7-year cycle. Stock market is overbought, and we only have 1 year to hit our downside objective. When it's going to happen, like I said, the probability of it happening in March is probably about 75%. What date? I have no clue. That's why, I'm going to be on my computer, I'm going to be around, I'm going to be on my phone, watching for the right time to get my investments in. But like I said, I don't really know the dates, but I'm going off past information and saying that there's a possibility, 75% chance possibility, that we will see the end of a bull market in March and a decline to start. So there's really nothing else I can tell you. So I wish you all the best of luck. And oh yeah, there is one thing I forgot to mention. It all goes back to oil. Let's go back to oil real quick. The bombs and oil. I'm so sorry, I almost forgot one of the most important items on this. Okay, so if oil is going to go up to $200, the reason oil is going to go up so much is because bonds are going to drop and the dollar will lose its value. The dollar will lose its crown as the exchange currency for oil. And I am so sorry, I almost forgot this. There's one more article that I was going to share with you all. Okay. I'm not sure if how many of you are aware, but in May 2014, Russia-China signed deal to bypass U.S. dollar. Demand for the dollar, which has long served as a safe and reliable service currency in international transactions, has allowed the U.S. to borrow almost unlimited cash, spend well beyond its means, which some economists say have afforded the United States an outsized influence on world affairs. But the BRICS countries, Brazil, Russia, India, China, South Africa, a bloc of the world's 5 major emerging economies, have long sought to diminish their dependence on the dollar as a means to reshaping the world financial and geographical order. In the absence of variable alternative, however, replacing it has proven difficult. For its part, China sees the dominance of the dollar in international trade transactions as a reamendment of the American global dominance, which they hope, remember, they don't like us, they hope to overthrow in the few years ahead, said Michael Clare, a professor of peace and world security studies at Hampshire College. This is a small step in that direction, to reduce the primacy of the dollar in international trade. Exactly. That's what's going on. You don't realize it. But if the dollar declines because we have too much debt and interest rates goes up to 10 to 15%, OPEC will probably step in and say, we will not accept US dollars in exchange for oil. Nope, anymore. It's coming. It's going to happen. When? Like I said, I don't know. But like I said before, stock market charts, price does not lie. This bullish pattern is telling me that oil is getting ready to take a push to $200 level. And that comment by the Secretary of OPEC has already he's already given us an insight of how high oil prices are going to go. So oil prices will increase because the dollar is losing value. The dollar will no longer be the world currency, the international currency. Interest rates will rise